When the market was on a roll, many investors were making big returns. But do you ever wonder why Warren Buffett was sitting patiently on that big cash pile of his? Why are you buying stocks when Warren Buffett isn't? And if you're confused whether to buy or sell, then this video is for you. Before we move on, make sure you press the like and subscribe button so that you don't miss anything related to stock market investing and financial freedom. Welcome to 5-Star Finance, the place where you learn how to achieve financial freedom. What better than Warren Buffett's annual letter? Because those letters are full of advice and offer a sneak peek as to how Buffett is thinking and what stocks he has planned to target and the overall investing landscape. Surprisingly, Warren Buffett has chosen to hold cash and to not go for stocks. This has many value investors thinking about why the legendary investor is not buying stocks. Is the stock market overvalued? In this video, we bring you all the key takeaways from Buffett's annual letter that can help you a lot in charting your future investment journey. Growing pile of cash in Berkshire Hathaway. Over the last years, Warren Buffett and Berkshire Hathaway have grown from $100 billion in 2018 to a staggering $144 billion in 2022. Why has Buffett chosen to keep cash instead of buying stocks? Now most of the value investors are going to question, isn't it a good thing that Warren Buffett and Berkshire Hathaway have a lot of cash in their hands? Well, it's a yes and a no. The cash on Berkshire's balance sheet has been going uphill since the last 10 years, but it has been pretty extreme over the last few years. So the good news is that Berkshire's operations over the last few years have been pretty productive and they have generated a lot of cash. That's great, but the negative aspect of this cash pile is that this year Warren Buffett hasn't made any purchase. That means that the eye of the legendary investor has not seen any attractive stocks. It is absolutely crazy to think that Berkshire holds so much cash that the company finances 0.5% of the entire US national bank. In the annual letter, Buffett also mentions that his company needs to hold $30 billion of cash at any time. We can think of this as a safety net which the company has developed in case the operations of the company start to struggle. Now, if we subtract that $30 billion from 144, we will get $114 billion, which the company needs to operate. If you're wondering how much cash that is, if we put it into perspective, that is enough to buy entire companies that come at market prices. So basically, we're talking about Goldman Sachs, IBM, Starbucks, and BlackRock. Now, it is important to note that we're not saying Buffett should buy these companies, but it really puts into perspective just how much cash Buffett has. The market is overvalued. Now we want to focus your attention on a single line in that annual letter, which arguably is the most important line in the entire letter. Berkshire's current position is a consequence of my failure to find entire companies or stocks that meet our criteria for long-term holding. Now you might be wondering why this particular line is so important. This line is Buffett's way of saying that the market is overvalued without flat out saying it. Throughout his entire career, Buffett has never been one to say his thoughts out loud about the market. Truth be told, we've never seen Buffett come screaming out in a press conference and saying that the market is overvalued. Instead, he has been much more subtle in his approach. Now, for example, let us take a look at his letter from 1999. This was the era during the dot-com bubble when the stocks related to internet and tech sources were at skyrocketing prices, even though they didn't have any stable businesses. The stock prices were increasing rapidly, and Buffett was being criticized for remaining on the sidelines. In response to that criticism, Buffett responded by saying that equity investors currently seem wildly optimistic in their expectations about future returns. If investor expectations become more realistic, and they almost certainly will, the market adjustment is apt to be severe, particularly in sectors in which speculation has been concentrated. This again was the Warren Buffett method of saying that the market was overvalued. And guess what? It turned out that he was right. The Nasdaq, which is an index pool of technology companies, topped out at around 5,000 in the year 2000. That is exactly when the dot-com bubble burst. And moreover, in the year 2002, the Nasdaq hit 1,200, and the Nasdaq could not return to its normal levels till 2015. The Nasdaq was so overvalued during its peak that it took 15 years for its value to be restored. There are different methods value investors apply for determining the value of stocks, but the purpose of this example was to state just how accurate Buffett was. Price to earning ratio. One of the most common metrics employed by value investors to determine whether a stock is overvalued or not is the PE ratio. It is calculated by dividing the share price by the earnings per share. If the ratio is high, that means the stock is overvalued. If the ratio is on the downside, that means the stock is undervalued. The PE ratio of the S&P 500, which consists of 500 of the largest companies in the US, is currently at 24x. Now, if you look at the last 90 years, the average ratio for the S&P 500 has been around 15x. By comparing it with the current annual ratio, which is 24x, we find out that the market is overvalued only according to this method. Buffett's method of determining a stock's value. The method created by the legendary investor is named the Buffett Indicator. According to this method, the math is actually quite simple. When we divide the value of all public stocks in a country by the gross domestic product of the country and then multiply it by 100, GDP is essentially the measure of size of the country's economy. But in simpler terms, the Buffett Indicator is the value of all the public stocks in a country divided by the GDP and then multiplying that value by 100. By doing some quick math, we can find out that the current value of all public stocks is standing at $46.2 trillion, and the GDP of the US is standing at $24.1 trillion. By multiplying the obtained value of 1.2 by 100, we get 192%. The Buffett Indicator brings us to another trillion-dollar question. How do we compare it with history? The answer to this question is quite simple. Since the late 90s, the timeline shows us that a percentage of 122 is a fairly valued stock market. But since we're standing at 192 currently, what conclusion can we draw from this? The companies in which Buffett has always invested heavily in the last few years are Apple, Bank of America, and Coca-Cola. Interestingly, Buffett has spent millions of dollars of investment in his own company as well, and that is Berkshire Hathaway. Since Buffett has not invested in any stocks, that brings us to a conclusion that Buffett has spoken again. If you're new to value investing, we made a free ebook to help you analyze stocks the correct way in order to prepare for the next bear market. Click on the description below to grab your free copy of the 6 stock categories. Our ebook that shows everything about the different stocks you could allocate in your portfolio and how the approach to analyze each one of them can give you more precision to invest. Subscribe and turn on notifications so that you don't miss anything. Check out this video we handpicked for you, and we'll see you in the next one.